Sanjeev, let me come to you. You're a strategist. You have a global view. You can invest, or you can tell where to invest almost anywhere in the world. Tell these audience out here, they're young people going to start their career. Where should they be investing in the world?
Okay, one of the interesting things about the next several, maybe a decade, is going to be the fact that China is going to wash the world with capital. This is something, this is going to be the great age of Chinese capital.
So interest rates will remain low?
Yes, and but in a very specific way. So basically what's going to happen, you have a country which is now $11 billion, $1 trillion in size, and it saves 50% of its economy. And it also has a 50% investment rate. Now, the problem is that for a country to invest $5.5 trillion every year when you have brand new infrastructure, you're moving out of manufacturing into services, your workforce is already shrinking, it's almost impossible. I mean, you can build a few highways to Tibet and all that, but it's all cheap stuff compared to the amount of money you have to invest. So what happens? What happens is basically that your investment rate at some point begins to rapidly decline. The problem is that your savings rate does not decline quite as fast. Why? Because you're rapidly aging. And
you won't consume?
You will consume more.
But not in that rate?
Not at the pace at which. So two things will happen. One is that the Chinese economy will, at each stage, every year, grow a little bit less slow. So we have already seen it now growing somewhere in the 6 to 7% range. A few years from now, it'll be in the 5 to 6%, and so on. Which is nothing very bad. I mean, it's a shrinking population, so the per capita income is still rising very fast. But for the world, what happens is that, remember, the current account deficit is the difference between your savings rate and your investment rate. So China ends up running enormous current account surpluses. Now, what does it do with this money? It has to simply pump it out, because if it doesn't pump it out, it causes all kinds of problems on its exchange rate and inside its own economy. So the world gets washed with, $500 billion or something in that range of Chinese money, which is already beginning to happen. Now, what does the rest of the world do? Of course, it's good for India in some ways because it keeps international capital cheap. But what happens is that for the world to remain functioning, in order for somebody to have a surplus, somebody has to have a deficit. And the only country in the world that has the space to absorb this kind of capital is the US. The good news is that the US actually has some use for it. I mean, those of you who visit the US will know. I mean, now New York has infrastructure that is worse than Bombay.
You want to repeat that?
Yeah, I'll repeat it. Anybody who's gone to, LaGuardia Airport is worse than Guwahati now.
Wow.
So, no, it's not kidding. I'm not kidding. I've been to both recently, and I can tell from personal experience that Guwahati is vastly superior to LaGuardia.
Tomorrow's headlines today.
So, there is use for this capital in the US. And given that the amount of capital there is, my feeling is that even if the Fed begins to tighten, it may tighten in the short end, but the long end, because of the availability of cheap capital, will not move anywhere. So, given the amount of cheap capital, the US has the opportunity to take the capital and do something with it.
Punita, he's talking about growth, world is looking at deflation. What's your take on all of this?
See, I think barring the US, the rest of the world is clearly in deflation right now. And US economy is doing quite well. So even if the US raises rates, I think that won't really affect the entire global economy, because there will be countries like India which are going to still cut rates. So I think there's going to be some decoupling that might happen, and individual countries will actually do their own thing. Now, of course, capital is, India in particularly is very heavily foreign investor driven in terms of the ownership. And so capital will definitely move after Janet Yellen raises rates, and capital will, potentially go more to Europe, which is what we've been already seeing this year. We're seeing, as Sanjeev said, it go to India. But one of the things Sanjeev said that I think is important, and I'm also been thinking for the last, several months after the Indian stock market has gone up so much, is that this time around the bull market in India that you talked about is actually a little bit different than the previous bull markets. The previous bull markets in India have been accompanied by very strong corporate growth. This time around the bull market happening in an environment of very low corporate growth. In fact, corporate earnings are at the worst ever quarter almost. So and also when you look at while yes, some stocks have gone up a lot, if you look at the broad market in 1999, when I remember from my days, the market was up 140%. In 2007, the market was up about 70-80%. So far, it's not been up that much. And so, and I think what's sort of holding it back is the corporate earnings. So the government and the Modi win and all the hope has driven the market. The liquidity globally has driven the market. But corporate earnings have to deliver. And so I think the bull market could still have more legs if corporate earnings start coming through, but it is going to be pushed out a little bit because I think it's taking a while. But in terms of what Sanjeev said, the long-term implications of some of this, as I've been thinking, is that there's a lot of opportunity in many, many economies because a lot of innovation is still happening. So we shouldn't just focus on the stock market. We should focus on the unlisted segments of the economy, and particularly in countries like India, where there is going to be growth, and the stock market listed companies' valuations are quite high. For young people, there's a lot of opportunities to be entrepreneurs and to make a lot of money in businesses. A lot of new models, a lot of new businesses are going to come up in India. So, I mean, and that are going to be very led by technology. So just a simple example, payments bank. The RBI is going to give licenses out for payments bank. A lot of technology-led solutions in financial services are going to, a lot of new business models will emerge there. So the money can be made by investing in these unlisted new businesses and taking a longer-term approach and not just looking at buying what's listed and already at like an 80 PE or 40 PE. So another example, is digitization is going to be a big theme of this government. Modi ji has been going out and encouraging young entrepreneurs to come out with solutions for security, solutions around how to operate things,
e-contracts, e-governance,
everything. So there's a lot of technology-led innovation that will happen across many, many segments, and those businesses, people are creating businesses. You have to look for those businesses. So in my view, venture capital, potentially things like that could actually be a better investment than just the stock market.
Ramdev, you run a PE fund under the aegis of Motilal Oswal. Do you agree with her that the opportunities are greater in the unlisted sector, particularly technology-listed play, than in the listed sector?
Yeah, so we don't do technology stuff. We do non-technology private equity. And yes, opportunities are there. We get to see 500, 600 deals in a year for doing 10, 12 deals, So clearly there are deal flows, but I kind of disagree with the fact that it's available cheaper. Actually, at times, the private equity deals are more expensive than the secondary market. Because in primary market, what is happening is you don't have that much research. And in the private equity, the companies are very small and there are a lot of promises. You sell the promises in private equity. If there is one thing which is sold, it is all promises. And we know those things don't come true. I mean, I know it in the last 30 years. None of these investment bankers' promises are right. So they sell price to hope. And yeah.
No, not venture capital. Not venture capital.
No, I'm talking about growth capital. I'm talking about growth capital. Venture capital is only hope. So
yes, but that's where I think.
So in private equity, I'm saying, I'm with the actual experience, I'm saying. So there are a lot of hopes, but so that's for actually more seasoned guys. Those who have seen that. I mean, throughout the investment banker in the discussion and tell them that these numbers are all wrong. I will not look at the numbers beyond 12 months or something like that. So
because they never met.
Yeah, they never. I guarantee you that it will not work out. So you have to be very, very careful in private equity. It's a far more skilled job than going to the stock market. The stock market is a much better place. In India, you have almost 3,000-4,000 companies listed, all size and shapes. You give me a theme, there are stocks. Whether good or bad, that is different. But there are stocks. So I think really the young people should definitely try their hands investing in India. and investing, not speculating. One of the problems is all the schools, they teach so much of derivatives and trading skills, and so that's the problem. Problem is, I think secondary market offers wonderful opportunity in India to start learning to invest and invest seriously in the long run. You might have, because of the current valuations, you might have slightly mediocre return on a 12 months, 18 months basis. But if you have a 5 to 10 years kind of thing, I think you have a wonderful time to invest in India.
There's an old Arabic saying, keep your gold, keep your silver, but give me your wisdom. That's exactly what this panel has done. So let's end this with a nice round of applause for them. Thank you.